companies. Alright, groups of companies. The first group which we have to consider is associated or connected companies group, which are nowadays called 51% group companies. So either you can call them 51% group or connected companies. Then we have 75% loss leaf group. Then we'll be discussing consortia. Then 75% capital gain group, VAT group, and transfer of trade within 75% common control. Okay, starting with the first one, and that is associated. Well, these are the old names. I would not suggest you to use that. Well, the modern name is 51% group companies. Okay, if you want to know that which of the companies would be member of 51% group, 51% group, well, when one company controls another company, such companies are called as connected companies. But make sure there should be, if I say that, for example, A Limited owns B Limited, C Limited, and D Limited 40, 60, and 80%. Well, in that case, everyone would declare that A Limited is not controlling B Limited. So B Limited would not be a 51% group, whereas C and D are. But what if there would have been some sub-subsidiaries? For example, E Limited and F Limited. For example, if C Limited owns Limited, let's say 55%, and D Limited owns F Limited, let's say 70%, whether E and F would be member with A, C, and D, because we already know C and D are 51% group companies. But what about sub-subsidiaries E and F? Well, for that, you have to look for effective holding. Well, effective holding over here would be 0.6 into 0.55, or in other words, we can say 60% of 55%. E could not be member of 51% group companies. On the other hand, what is the holding of A into F? Well, for that, it would be 0.8 into 0.7. That is a holding of 56%. So F would be 51% group company, because we own F directly and indirectly, holding at every level. Well, that means A Limited owns D Limited 80% at every level. D Limited owns F Limited. Well, this holding is also more than 50%. So this is called holding at every level. But this 56% is called effective holding of the ultimate parent company into subsidiaries. Well, that should also be more than 50% if you want these companies to be considered as 51% group companies. Well, once all of these companies are 51% group companies, what are the corporation tax implications? Okay, the implications are relevant to payment of tax. As you would know that companies pay their corporation tax in two ways, either in 9 months and 1 day, or in 4 quarterly installments. So if a company is earning augmented profit of more than threshold limit, which is usually of 1.5 million pounds, but not for those companies which are operating in 51% groups. Because over here, for A, C, D, F, we are going to divide this limit with for any of A, C, D, F, corporation tax threshold limit would be 3,75,000. So if any of the companies in A, C, D, or F have earned an augmented profits of more than 375,000, well, that company would be considered as above threshold limit. And if it was above threshold limit in previous accounting period, now it would have to pay corporation tax in 4 quarterly installments, which none of us are actually interested in, because when we say about payment of tax, so make sure this group have direct impact upon payment of tax, but make sure it does not have any impact upon calculation of tax, because the threshold limit is only relevant to payment of tax. Secondly, the income which we receive from such companies is called dividends. Well, as when we were studying the basic corporation tax performer yesterday, we discussed in detail that companies do not pay taxes upon dividends received from the other companies, either from companies of the UK or other companies from other countries. Dividend income for a company is an exempt income. Well, when we are finding out that what would be the payment date, this is what we do, that we account for non-group dividends and we add them into the taxable total profits in order to find out what. So we add up non-group dividends into taxable total profits in order to find out amount of augmented profits. So augmented profit is equal to taxable total profit plus non-group dividends. Keep in mind, not group dividends. So in this case, if you want to know that what are augmented profits of A Limited, you should be adding taxable total profits of A Limited plus the dividends which A Limited had received from B Limited only, because you only have to pick non-group dividends, and that would be only from B Limited. As far as C and D, well, they are group members, and if you want to know what are the augmented profits, you should add dividends if there are from B Limited. Well, that would be augmented profit. You have to compare that with the threshold limit, which in this case would be divided by 4, and that will be 375. So if A Limited would be earning an augmented profits of more than 370,000, they would have to pay tax in 4 quarterly installments. And when I say 4 quarterly installments, well, you would know that if a company would have to pay tax in 4 quarterly installments, well, in that case, let me show you if a company has to pay in 9 months and 1 day, and if a company has to pay in 4 quarterly installments. How do we pay taxes? Well, if it is in 9 months 1 day, let's say my year end was from 1st of April 2017 to 31st of March 2018. Well, if I have to pay my corporation tax in just one payment, and that is 9 months and 1 day, well, that would be 9 months will be 31st December and 1 day will be 1st of January 2019. So they must pay their tax in one payment by 1st of January 2019 if their augmented profits are less than corporation tax threshold limit. But if a company was above threshold limit, augmented profits were above threshold limit, in current as well as in previous accounting period, well, in that case, company would have to pay their taxes in 4 quarterly installments. Once again, if company was preparing its accounts from 1st of April 2017 to 31st of March 2018, but company has to pay tax in 4 quarterly installments, well, in that case, the first installment must be submitted by 14th of 7th month from the start of accounting period. Well, from here, as accounting period started from April, so the 7th month will be October 2017. As these are quarterly installments, next installment must be paid by 14th of January 2018. Next installment, which would be due, would be on 14th of April 2018, and then on 14th of July 2018. Well, the first three payments are payment on account of 25%, 25%, 25%, and 25%, which is actually a balancing payment and is usually approximately 25%. So, if you look at these two payment methods, in one case, we just do not pay any taxes while the accounting period. We do not pay even after the accounting period until it's 9 months and 1 day. But on the other hand, you make payments within the accounting period, and by almost 3.5 months after the end of accounting period, you're done with all the payment taxes. So, which kind of payment method you would be interested in for your company? Obviously, 9 months and 1 day. So, whenever in the exam, we will be dealing with the rest of the groups in which we can surrender loss so that their taxable total profits could reduce. We'll make sure our top priority would be to reduce the augmented profits of such companies that much that it should become a company with augmented profits of less than corporation tax threshold limit, and it should pay in 9 months, 1 day. Well, that would be the best case scenario, but the bare minimum you should still be deducting losses from companies, because this would reduce their installment at least. So either you would be reducing installment, or you would be trying bringing them down to below threshold limit, and that's why the payment would be changed from quarter installments to 9 months and 1 day. Well, one of the implication is corporation tax threshold limit for companies. Well, that has direct impact upon payment of tax, and secondly, which has again impact upon payment of tax, dividend received from any of the connected or group companies is not added into the taxable total profits in order to find out augmented profits. Why? Because we only add non-group dividends to that. Now, let's talk about what if during the accounting period we sold a subsidiary that much that it is no longer a subsidiary, or we purchased the company's shareholding that much that it becomes a 75%. It becomes a subsidiary. Well, for that, let me give you an example. All right. For example, A Limited owns B, C, and D. A Limited owns B Limited 60%, C 70%, and D 40%. So D is not lost leave group member. But this B Limited, well, the year end of A Limited is 31st of March. And during 31st March 2018, at 1st January 2018, A Limited purchased its 60% shareholding. A Limited purchased a 60% shareholding in B Limited. Well, keep in mind, right now you can see that there are 1, 2, 3, three connected companies, and you would be thinking to divide the limits by 3 by year ending 31st March 18. But keep in mind, this is the year end, this is the counting period in which B just joined the group and become a 50% subsidiary. So, if a company is acquiring another company by more than 50% in any accounting period, such company would not affect corporation tax threshold limit in the accounting period in which it is acquired. Rather, it would be counted as group company from next accounting period and in which it was acquired. So if I ask you in year ending 31st March 18, what A and C should divide their limits with, well, your answer should be 2. But if I ask you in year ending 31st March 19, what this A limited group should be divided its limit with, well, that would be 3. All right, sold more than 50%. For that, let's have another example. For example, there's this other company, A Limited, which owns B, which owns C, and which owns shareholding in D Limited. Shareholding in B was 60, shareholding in C was 70, shareholding in D was 100. So all of them are 51% group companies, and they are 51% group companies since 2000, January 2002. Now, but in year ending 31st March 2018, A Limited is deciding to sell all of its shareholding in B Limited to all of its shareholding in B Limited at 1st December 17. So by this year end, we would not have B Limited with us, as it would be as all of its shareholding would be sold by 1st December 17. Now my question is, by what number I should divide the threshold limit of A Limited for year ending 31st March 18? Well, for answer you should you would find the answer over here. If a company sold more than 50% in any accounting period, it would still be included as connected company and will affect corporation tax threshold limit in the accounting period in which it has been sold, but it would not form from next accounting period. So if I ask you in year ending 31st March 18, what A Limited, C Limited and D Limited should divide their limits with, your answer would be still 4. But in year ending 31st March 19, a year end following to this one, yes, in that year they would be dividing their limits with 3. So that is all about 51% group companies. What are the implications? Corporation tax limits are to be divided with the total number of connected or 51% group companies. Group companies' dividends are not included in augmented profits, and a company which has been sold during the year would remain your group company for that accounting period, and a company which is acquired during the year would not become your connected or group company in the accounting period in which it is acquired. Well, moving on to the next thing is 75% loss relief group. Well, firstly, let's have a look at that how 75% loss relief group construction exists within two companies or more. Well, when one company owns at least 75% shareholding at every level. Well, what do I mean by that? All right, let's try to understand with the help of this example. A Limited owns B, C, and D Limited, let's say 80%, 100%, and 70%. Now you would say exclude D from loss relief group as A does not hold directly into D 75% or more. So D would not be included in loss leave group, but D is 51% group company. Now, if I say there is a 70% subsidiary under C, that is E Limited, and there is a 90% subsidiary under B, that is F Limited, I would say that you should not check effective holding of A into E. Why? Because it is not fulfilling first condition. Well, what is first condition? First condition is that there should be a 75% shareholding at every level. At every level means A should necessarily not be holding every company more than 75%. Well, if A owns C, C owns E, and E owns some other company, at every level, the holding must be at least 75%. If that is not the case, you should not be calculating effective holding of A into E. Why? Because a company which does not fulfill first condition would not fulfill second condition as well. So just forget about the second condition. By the way, if you would do that, even then it will be 0.7%, which is less than 75%, as effective holding of the ultimate parent company, A Limited, in sub-subsidiaries should also be at least 75%. So right now we can say, yes, C could be member, B could be member of loss leave group, but not D because it does not fulfill first condition. So does E because that also does not fulfill first condition. As far as F is concerned, it fulfills the first condition, but as it is sub-subsidiary, we have to consider what is effective shareholding of ultimate parent company into sub-subsidiary. Well, that has to be more than 75%, which is right now 72%. So that means the second condition is not fulfilled by even F Limited. So the members of loss leave group in this group are A Limited, B Limited, and C Limited. All right, let's try to have another example where A Limited owns B, C, and D. Let's say if A Limited owns B Limited 90%, 95%, and D 75%. So right now A, B, C, D all are member, but if I say there's E, there's F, and there's G with a holding of 95, 75, and 70. Well, we are quite sure that A, B, C, and D are members because yes, they are direct subsidiaries and they are more than they are 75% or more. Now, as far as G is concerned, obviously it could not be a subsidiary because it is not fulfilling first condition. Well, for F, yes, we should consider the effective holding, which is, I think, 0.95 into 0.75. Well, that is 71%. So F could not be member. Yes, you were right. And so if we look into E, well, that will be quite sufficiently more than 75%. And yes, that is 85.5%. So yes, E is also member. So it will be A, B, C, D, and E. And now, if I ask you that which of the companies are 51% group companies, well, I think all of them, because at every level there is a holding of more than 51% everywhere. And if you can take the effective holding, well, that is also more than 50% on almost every situation. So all of them are 51% group companies. But as far as loss leave group is concerned, well, that will be A, B, C, D, and E. So now we know which of the companies are member of loss relief group. Well, the next thing now would be, what is the benefit to A, B, C, D, E of being member of loss relief group? Well, they are now allowed to transfer their losses within loss relief group members. Well, which losses? Almost every loss other than capital losses. It could be a trading loss, it could be a property loss, it could be an interest deficit, or it could be QCDs which were unrelieved, or it could be unrelieved management expenses of investment companies. Unrelieved management expenses of non-trading or investment companies. Yes, non-trading companies could be part of loss relief group, but they could not be ultimate parent company. If they are, they would not be member. Rest of the companies would still be members. So they could be a subsidiary in this group, but they could not be ultimate parent company. And if there are any unrelieved management expenses, as we discussed them yesterday, yes, those unrelieved management expenses could be surrendered to any group members. So any loss other than capital loss, this is how I say it. So it could be trading loss, it could be property loss, it could be interest deficit, it could be unrelieved QCD and unrelieved management expenses of non-trading companies. Well, if both the companies, the company which is surrendering its loss and the company which is claiming its loss, claiming the surrendering company's losses, well, if the both companies have same year ends, well, in that case, we can surrender any amount of our choice to any of the group members. Well, there would be a problem whenever there is a situation of non-coterminous. But we will be discussing non-coterminous situation in a while. Let's first discuss that what if all of the companies would have same year end. Well, in that case, we can transfer any amount of loss from one group member to another group member. But make sure we can only surrender current year losses, as we are not allowed to surrender any brought forward losses. Well, the rule is as strict as, well, if these are losses from January to December to A Limited, and A Limited want to surrender it to an other member, B Limited, well, it should be profits of B Limited from January to December. If the loss is from January to December for A Limited, and A Limited wanted to transfer it to B Limited, you can only use profits of B Limited for the same period, that is January to December. Then, so keeping this thing in your mind, I hope there is now no provision in your mind that you can transfer carried forward losses, as they would have incurred some years before. So, as the rule is as strict as I'm telling you that if the losses from April to March 2017 to 18, well, the claimant company must deduct this loss if claimed from April to March profits. So, right now, if we say that, let's say there is this group in which there is A Limited, which owns B, C, and D Limited. 80, 90, and 100%. So yes, right now we have A, B, C, and D as group members. So over here, if I give you some financial information of A, B, C, D, well, all of the companies so far have a year end of 31st March 2018, and this is the information for this year end: A, B, C, and D. Let's say the trading profits which were earned by A Limited during the year were 600,000. B Limited earned 380,000. C Limited is suffering losses, and D Limited 3,70,000. Well, the other income which all of the companies are earning is property business profits of 20,000, of 10,000, of 20,000, and of nil. Assuming these are the total incomes earned by the companies and no gifted donations or QCDs. So 20,000, 390,000, 20,000, and 370,000. Well, the additional information is non-group dividends received by the above companies. Well, A Limited had received a non-group dividends of £50,000. B did not receive any non-group dividends. C had non-group dividends of 5,000, and D had them of 10,000. Well, the last piece of information is tax adjusted loss of C Limited. Well, tax adjusted trading loss of C Limited was 100,000. Where should I be deducting this loss first? But keep in mind, you can deduct this loss from wherever you want to, from whichever company you want to, and as much as you want to. Why? Because all of the companies are loss leave group member, and all of the companies have same year end. When this is the case, you can deduct any amount of loss you can deduct any amount of loss out of any amount of members up to any amount of your choice. So I would like you to think about it and tell me that where should I deduct the loss in priority? Well, the planning is you should keep in mind those companies which are paying tax in 4 quarterly installments should pay in 9 months 1 day, and they would if they are below threshold limit. So let's do that. Well, first of all, you should keep in mind that there are 4 companies in the group which are loss leave member, which are also 51% group companies, and that's why corporation tax threshold limit for these companies would be divided by 4, and that would be 3,75,000. So any company over here which has an augmented profits of more than 3,75,000, our first priority would be to bring it to 375,000. Well, right now you can see that we have A and B, but make sure we do not decide from taxable total profits. We decide them from augmented profit, which is calculated by adding taxable total profits and the dividends from non-group companies. So effectively, the augmented profits of A Limited are 6,70,000. For B, it would be 390,000 as there are no dividends. For C, it will be 25, and for D, it will be 3,80,000. Well, there are 2 companies which are, in fact, 3 companies which are paying tax in 4 quarterly installments, most probably. So, well, your first priority should be those companies whose world could be changed from 4 quarterly installments to 9 months 1 day, because there is a loss of only 100,000, make sure we would only be available with a limited amount of loss or not unlimited. So if there is a limited amount of loss of 100,000, which if I deduct from a limited, still it would not change the payment date, but just reduce the installments. So I would give priority to these two companies first, and then if there is any loss left, I would be deducting that from a limited. Well, in order to do that, this group loss should be first deducted from those companies whose payment method could be changed. Well, for B Limited, it could be changed if B Limited would be on 375,000, as B Limited does not have any non-group dividends. So for 375,000 to be over here, we should deduct, all right, 15,000 of loss has been deducted from here. Then next should be, let me see, well, this will be the company, D will be the company where we should be deducting losses. As if we would not, D would be in above threshold company. Looking at their taxable total profit, no, that it is not, but looking at its augmented profit, yes, it is. So we should deduct 5,000 so that there should be taxable total profit of 365. If added to 10,000, they would not become 380 now, they would become 375, which means company is below threshold limit. Now, we have used a loss of around 20,000 pounds in both companies, and we still have 80,000 of losses left. And yes, now we have, this one is below threshold, this one is already below threshold, and this one is also already now below threshold. Yes, the remaining loss should be deducted from A Limited. And this would be the best use of loss we can do in this group. All right, now the next thing which you may be in accounting, which you may be encountering in the paper would be non-coterminous accounting period. Well, as I was saying earlier, that if A Limited wants to surrender its loss to B Limited, this is what HMRC wants you to do. If A Limited's losses are from January to December, it should be profits of B Limited from January to December. If it is not, because of different year ends, still loss is to be surrendered that way. Well, how we are going to do that? Let's try to understand that with the help of example. Well, let's assume there is this groups of company in which A Limited owns B and C Limited 90 and 100%. So over here, A, B, and C are member of loss relief group and member of 51% group companies. But the problem is, during year ending 31st December 2017, B Limited suffered trading loss of 180,000. But B wanted to transfer its loss to A Limited, and the problem is A Limited had prepared its accounts for year ending 31st March 17 and year ending 31st March 18. Now these are for A Limited. Well, so A Limited has following incomes: trading profits. Well, the trading profits in year ending 31st March 17 were 140,000. And in year ending 31st March 18, they were increased to 220,000. Then there were certain chargeable gains earned by A Limited in year ending 31st March 17 of, let's say, 30,000 and let's say 50,000. All right. So we have taxable total profits of 170,000 in first accounting period and 270,000 in second accounting period. And there are losses of 1,80,000, but those losses were generated in B Limited from January to December. And the profits over here we have are from April to March. Now, if we want to surrender loss of B Limited, which is from 1st January 2017 to 31st December 2017, you have to account for that it must be, if it is loss of January to December, their profits must be from January to December. So how many months would you be incorporating in year ending 31st March 17? Well, obviously, it will be from 1st of April 2016 to 31st of March 2017. Well, yes, there will be 3 months matching to this one. And then they prepared their accounts for year ending 31st March 2018. And 9 months will be matching over here. So we can say comfortably that out of this loss of 12 months, 3 months loss could be surrendered over here and 9 months loss could be surrendered over here. But what is the maximum loss which could be surrendered by B Limited to A Limited? Well, this is how you should be calculating that. Well, the maximum loss which could be surrendered in respect of year ending 31st March 2017. As the matching period is 3 months, you would say it would be lower of. Well, you have to count for taxable total profits and loss. Taxable total profit of the claimant company, but for the matching period. So as we have taxable total profits of 170,000, but that was of 12 months, we just need 3 by 12. So that'll be 42,500. On the other hand, the loss was of 180,000. And we have to count for 3 by 12. Well, that will be 45,000. Well, in this case, maximum loss which you would be able to deduct from here as group loss, well, that would be 42,500. But on the other hand, what is the maximum loss which you can deduct in respect of year ending 31st March 18? Well, that's quite simple now. Year ending 31st March 18. As we already noticed, the matching months, the coterminous months are 9. So that's why lower of 9 months taxable total profits and 9 months. So taxable total profits of 2,70,000 into 9 by 12. Well, that will be 202,500. And the second thing would be loss. Loss of 1,80,000 into 9 by 12. Well, that'll be 135,000. So the maximum loss which could be surrendered by B Limited to A Limited in respect of year ending 31st March 18 would be 1,35,000. You would not be able to deduct any more losses than 1,35,000 in respect of year ending 31st March 18 and 42,500 in respect of year ending 31st March 17. Well, another reason why you would be dealing with non-coterminous scenario could be that A, B, and C all have same year ends, but we have acquired or disposed a member during the year. Now, for example, let's say that A Limited had owned B and C Limited 90% shareholding since 2002. But during the year ending 31st March 2018, at 1st January 2018, we A Limited sold its 90% shareholding in B Limited. Well, now it's a common sense thing that we should know that this company becomes a non-group company on 1st January 2018. And now, if I say that B Limited is suffering, let's say, trading losses of 120,000 in respect of year ending 31st March 18, you would not be able to claim all of these, as during the year ending 31st March 18, B Limited was on your member only for 9 months. So that's why you would not be able to claim more than 9 months loss. Although the year end has been same, but if a company is acquired or sold during the accounting period, well, when it is acquired from then onwards, we can claim its losses. And when it is sold from then onwards, we would not be able to claim its losses. All right, so this is what we do in the case of non-coterminous. We find out the coterminous or matching period, and we find out losses of the surrendering company for the matching period and profits of this claimant company for the matching period, and then we took lower of both, and that is a maximum loss which could be surrendered by one group member to another if there is a non-coterminous accounting period. Now, let's talk about whether the overseas members would be considered as member or not. Well, yes, overseas members are considered as group members, but losses could not be surrendered or claimed from such members unless this overseas member is an overseas subsidiary residing in European area, and in this case, make sure we are not allowed to do whatever we want to, but only one way surrendering, and that is if there were losses in overseas subsidiary which is residing in European Economic Area, and we want to surrender these loss to its UK parent only. Make sure none of the other options would be available. It cannot surrender its loss to other group members in UK other than its parent. So none of the other possibilities are allowed. Only one thing, one-way surrendering is allowed. And when I say one-way surrendering, well, I mean that loss would be surrendered if the loss was generated in overseas subsidiary which resides in European Economic Area, and it surrenders its loss to UK parent. This is the only allowed way. Other than that, we are not allowed to surrender losses in any other way from or to any overseas group member. So that is all about what we say loss relief group. Now here is an example that is that A Limited and B Limited are members of 75% loss relief group, and these are their accounting profits. So we were saying that why do we not have any consortia over it, and all of the loss of Y belongs to A and A belongs to Y, and B wouldn't be of no use in this construction. Okay, let's have another example. For example, this Y Limited is owned by A Limited, B Limited, and some individuals. All right. A Limited owns it 60%, B Limited owns it 20%, and individuals own the rest of the 20%. Well, I think over here consortia exists because A's individual shareholding into Y is 60 and B's individual shareholding into Y is 20, and that's why consortia exists. And when consortia exists, what are the benefits available? Well, the benefits are we surrender the loss if there are losses in these two companies as consortium members, and this company in which holding is, this is called consortium company. So losses could be surrendered upwards from consortium company to consortium members, or downwards from consortium members to consortium company. So make sure it could be either upwards or downwards, but parallel surrendering is not allowed. So members could not relieve any losses within each other. All right, now we know when does a consortia exist and when it does not. Let's have a look at how loss are to be surrendered and or claimed. If there are losses in consortium member, these losses could be surrendered downwards to consortium company, but only up to a percentage of its holding in consortium company against its taxable total profits. So what is the maximum loss which we can surrender downwards or upwards? Well, if I say that Y Limited is owned by A Limited and B Limited, let's say 60-40, well, there would be a consortia existing over here. Now, if we want to know that what is the maximum loss which could be surrendered by A downwards to Y Limited. If I'm not wrong, we are studying downwards, yes. So, if we want to know that what is the maximum loss which could be surrendered by A Limited to Y Limited. For example, A Limited suffered a trading loss 200,000 and we want to give this loss, surrender this loss to Y Limited, and Y Limited had taxable total profits of, let's say, 250,000. Now, what is the maximum loss which could be surrendered by A Limited to Y Limited? Well, the maximum loss will be lower of, number one, trading loss of the surrendering company of the A Limited, that is 200,000 as it is. But as far as Y Limited is concerned, their taxable total profits would be apportioned according to the sharing ownership. As we do not own all of this company, so 250,000 into 0.6. Now that'll be 150,000. So the maximum loss which A Limited could surrender downwards to Y Limited in this scenario would be 150,000. And if we want to surrender it upwards, same thing applies. And for that, let's say if A Limited had taxable total profits of 500,000 and Y Limited has losses, trading losses of 180,000, and assuming Y Limited does not have any other incomes. So in that case, what is the maximum loss which could be surrendered by Y to A Limited? Well, once again, you have to take lower of. As far as taxable total profits of A Limited were concerned, we can use them as it is 500,000. But as far as loss of Y Limited is concerned, which is 180,000, make sure all of the loss does not belongs to us, as we are not in loss leave group, we are in consortia. So we can only claim up to maximum of 60% of this loss. So 180,000 into 60% would be 108,000. So the maximum loss which could be surrendered upwards by consortium company to consortium member would be 108,000 in this particular scenario. All right, now I would have included an example over here for your consideration. So let's have a look at this example. There are losses in Rose as well as in Pink Limited, and Mauve Limited and Blue Limited are profitable companies. Well, first of all, we need to know whether there is a consortia or not. Well, we can see there are 2 or more companies which owns shareholding in Blue Limited. Well, their combined shareholding 50 plus 35 is 85 plus 1500. Their combined shareholding is 100%, and their individual shareholding is not ranging more than 74 or less than 5%. So yes, consortia does exist. Calculate the corporation tax liabilities of all the companies on assumption that maximum amount of consortium relief is claimed, and explain how your answer would differ if Rose Limited owned 80% of Blue Limited, with Pink Limited and Mauve Limited owning 10% each. I hope there are no problems in the example. If there are any, you please feel free to ask it from me. So right now I'm going to focus on the second requirement, which was, what if, explain your answer, how your answer would differ if Rose Limited owned 80% of Blue Limited. All right, let's make it 80%. With Pink and Mauve Limited owning 10% each. Well, in that case, Rose and Blue would have a loss leave group, and Pink and Mauve would not have any beneficial construction with Blue Limited, and consortia would not exist. And in that case, Rose Limited would be able to surrender all of its loss of £90,000 to Blue Limited, and would be able to deduct all of its losses. Well, in that case, it would be done something like this. And that's why the taxable profits of Rose would be reduced by a whole amount of losses of Rose. I think you got it. So this is what we do in consortia. Make sure whenever we talk about consortia, the third condition focuses only on that individual shareholding should not range more than 74. Because if it would range more than 74, which is the case right now, well, in that case, all of the losses of Rose Limited would be surrendered to Blue Limited. Moving on to the next implication or next group, well, that is 75% capital gain group. This group, 75% capital gain group, this one exists. Well, the conditions are more or less same, with exception of that at every level holding should be 75%, but effective holding of ultimate parent company into sub-subsidiaries needs not to be 75 as well. Well, for 75% capital gain group, it needs to be at least more than 50%, and that is all. So, for example, if A Limited owns B, C, and D, let's say 100, 90, and 80, well, yes, all of them are member of loss leave group. All of them are member of capital gain group. But if there are any subsidiaries, let's say E Limited, in which there is a direct holding of 75. Well, right now, first condition has been fulfilled by all of the companies. Well, as they are not sub-subsidiaries, second condition is not relevant to B, C, and D. Well, as far as E is concerned, that is a sub-subsidiary, and we should find out what is the effective holding. Well, that'll be 0.9 into 0.75, which is 67.5%. So no, E could not be member of loss leave group, but E is member of capital gain group, because effective holding in capital gain group needs not to be 75%, it needs only to be more than 50%. So there would be a member, a company would be considered as a gain group member if the effective holding, if it's a sub-subsidiary, and effective holding of ultimate parent is just more than 50, not 75% or above. All right. Now, if we know that these are the companies which are members, which, by the way, which of the companies were members? A, B, C, D, as well as E is member of gain group. If I ask you what are the members for loss relief group, the group which we were studying before, Consortia, well, for that, A, B, C, and D. And if I ask you which of them are 51% group companies, well, I think, yes, once again, all of them, A, B, C, D, and how beneficial constructions are identified for corporation tax purposes. Now, let's have a look at that. What are the benefits available to A, B, C, D, and E of being member of gain group? Well, the first benefit which we have, if an asset is sold or transferred within capital gain group members, it would deemed to be transferred at indexed cost. Well, if your deemed proceeds are indexed cost, what you're going to deduct out of it? Well, that's indexed cost again. So it will always result in no gain and no loss. And because of that, we are able to do the next thing as well. Well, we are further allowed to make a notional transfer of asset before sale to any of the group members, which allows us to transfer the gains and losses within the group. Well, the notional transfer of asset is allowed within the gain group members, due to which you can transfer one member's capital gains or capital losses to an other member by just making an election, which is to be made within 2 years of the end of the accounting period. So the first implication is there is no gain and no loss if there is an actual sale of assets within the gain group members. Well, the second one is we can transfer any amount of capital gain or capital loss by making notional transfer of asset, by making just an election, so that gains and losses should be matched against, as if you remember that capital gains and capital losses are to be matched against each other, and if there are any losses, they are to be carried forward against future net gains, and we never deduct them from total profits. So that's why these losses, so that gains and losses should be matched against, and overall corporation tax of the group may be reduced. Further, a third and very material benefit is that for rollover and holdover relief purposes, all of these members are considered as one company. That is, any one of them could sell a qualifying asset, and any one of them could purchase a qualifying replacement asset, and still we would be provided with holdover as well as rollover, depending upon choice of replacement asset of the member. So for rollover and holdover relief purposes, what benefit we have in capital gain group, that any one of the group member could sell a qualifying business asset, and any other member could buy, and still rollover and holdover reliefs would be available. All right. But as you can notice that I wasn't discussing these examples in these brackets in detail, well, we will be discussing them now. Green Limited acquired a building at 1st April 1996 for 100,000, and today they are transferring this building to Jade Limited, which is a wholly owned subsidiary. Well, a wholly owned subsidiary means it is a capital gain group member because the holding is more than 75%. For 90,000, well, we are not going to use these actual proceeds because we would be transferring this asset at indexed cost from Green to Jade Limited. When it was worth 1,80,000, on 1st December 17, Jade Limited sells the office building outside the group for 350,000, and these are the relevant RPIs. So spend good 5 minutes on it and try to notice that how transaction is to be dealt with if this comes into your exams. So when it was first transferred by Green to Jade Limited, well, it would have been done on indexed cost. So we are only required to calculate indexed cost at that date, so that we should know from now onwards Jade Limited would recognize this building for CGT purposes at 129,700. So whenever this would be sold, Jade Limited is going to deduct 129,700 and then indexation allowance. But make sure the indexation should be October 2005 to the date of sale. Make sure, because till October 5, whatever the indexation was, that has already been included in this base cost. So that's why 129,700, 20,200, 220,300 is your unindexed gain, and then indexation from October 5 to the date of sale, and these will be the chargeable gains. So if the asset is been sold within the group, it would always be sold at no gain, no loss, because it would be deemed to be sold at indexed cost. So the gains would ultimately be realized in the hands of those members who would be selling it outside the group. All right, now let's try to focus on the brackets which we left earlier. Well, for those brackets to be considered, from now onwards, you should keep in mind whenever in the exam you find out that is giving you a situation in which, let's say there was this company A Limited which owns B, C, and D, let's say wholly owned. That is 100%. And in the exam scenario, what is happening that A Limited is selling all of its shareholding in D Limited. Whenever this would happen, I think you are clear that D Limited would be D grouped. And whenever a company is getting, whether degrouping charge is to be applied or not, it would be applied on A Limited. So how would we know that whether the degrouping charge would apply or not in any particular scenario? Well, the first thing which you should notice that if a company is getting degrouped, how it would be getting degrouped? That it would be getting degrouped over here if A Limited would be selling at least 26% shareholding. Well, that will make D Limited a 74% subsidiary, which is not a member of capital gain. So, if a group member's shareholding has been sold in such a way that it no longer remains a group member, so that over here, if we will sell 26 or above, D Limited would not be a member of capital gain group. And you should take care on A Limited, on disposal of D Limited, is there any degrouping charge being applied or not? Well, it would apply if both of the following conditions also fulfill. Well, one of the companies getting degrouped and this company which is getting degrouped, the D Limited, had received an asset at no gain, no loss from another group member within 6 years of being degrouped. So from today backward, the day when it is becoming degrouped, if it had received a no gain no loss transfer within 6 years before this date, well, we have a problem. And we are certain that we have a problem if the asset is still owned by D Limited at the date of degrouping. Well, in this case, we must calculate degrouping charge. Now, what is degrouping charge? Well, we have to calculate gain by using market value. Rather than it being a no gain, no loss transfer when it was received, we have to calculate what would have been the original gain which would have been chargeable on D Limited on disposal of this building if this was not a no gain, no loss transfer. So we will use market value at the date of transfer when this no gain, no loss transfer was made, and that date, what was the market value, less allowable cost, whichever was paid, less indexation allowance once again till the date of transfer, and you just have to calculate the original gain, which was chargeable on the first place if it was not a no gain, no loss transfer. So, calculating that gain, what we should do with that degrouping charge or the gain? Well, this degrouping charge will now be added into the sale proceeds received in respect of sale of shares of the company being degrouped. Well, A Limited would have A Limited has sold its shareholding in D Limited. We will be calculating gains on the disposal of this shareholding. But if there is a degrouping charge, we would have to increase the proceeds on sale of D Limited by the amount of degrouping charge. So, or the original gain. Now, let me explain that with the help of this following example. Chalet PLC bought a freehold office block on 15th May 1997 for 3,50,000. On 10th June 2012, Chalet sold the office block to its wholly owned subsidiary, Wordsworth Limited, for 400,000. When the true market value of the office building was 6,20,000. On 1st of March 2018, Wordsworth Limited sold the office block for 800,000. I think 800,000. Both companies prepares the financial statements to 31st March each year. Assumed retail price index as follows. Calculate gain realized by Wordsworth Limited in March 18. Well, that is a requirement which we just solved a bit earlier. Right now, I would like you to focus on second requirement. Rather than have Wordsworth sell its office block, Chalet PLC sells its entire shareholding in Wordsworth Limited for 5 million on 1st March 2018. Advise the group of gains, if any, that will arise as a result of this sale and any reliefs available. Well, as you know that the shareholding has been sold for 5 million. What we are required to do is, firstly, we should check whether degrouping charge would apply or not. As Wordsworth Limited is getting degrouped after receiving a no gain, no loss asset. Well, this was received at 10th June 2012. 13, 14, 15, 16, 17, and 10th June 18, it would be exact 6 years. But at 1st March 18, it would be sold. So within 6 years of receiving a no gain, no loss transfer, Wordsworth Limited is gonna get degrouped. And so we should calculate degrouping charge. And how do we calculate degrouping charge? Well, we have to consider the original market value, which was 6,20,000, and should deduct the cost, which should be indexed to the date of transfer, which is 10th of June 2012. So we will be using a cost of 350. We will be using a proceeds of 620, and we will be deducting an indexation from 1997 to June 2012, and that would be the gain which would have been chargeable if it was not a no gain, no loss transfer, or the gain which is now be called as degrouping charge. And then this gain would be added into the sale proceeds of 5 million. So let's see what's happening over here. Well, let's come to the B part first. Well, this is what we say sale of Wordsworth Limited. Degrouping charge arises. Degrouping charge is treated as if it is sold the building on 10th June 2012. So 620 minus indexed cost till the date of sale, which we are using from the above calculation. As you can see, the indexed cost to date was 3,50,000 and indexation till 2012, 2033,350. So I'm using the same amount of indexed cost. So this is degrouping charge. Now this degrouping charge is to be added into the proceeds of 5 million on the sale of shares in Wordsworth Limited. Well, right now it would not impact much on the Blue Limited. Why? Because substantial shareholding exemption would apply. Why it would apply? Because Shelley PLC owns 100% shareholding of Wordsworth Limited, and that is why, and owns it for more than 12 months. So effectively, even if the proceeds were increased, still it would not have any impact on Chalet PLC because of the application of substantial shareholding exemption. So this is this is degrouping charge. Now, if we want to know that whether a company, all right, let me explain that. Let me explain a scenario, and then we will be discussing what pre-entry losses means. For example, there is this company A Limited, which owns A, B, C, and D. Let's say 90%, let's say 100% since 2002. And it also owns 80% of B since 1st January 2016. B Limited has carried forward capital losses of 100,000 and A Limited has just realized gains of 90,000. Now, should I make a notional transfer of asset to B Limited so that this gain should be chargeable in the hands of B and B would be able to deduct this brought forward capital loss? Whether the answer to my question is yes or no, well, that depends whether this loss was realized by B Limited pre-entry or post-entry. Whether the asset was sold before 1st January 2016 by B Limited on which this loss was suffered, or whether this asset was transferred after 1st January 2016 on which B Limited realized loss. Well, if the asset has been sold after joining the group, that is 1st January 2016, in that case, we are allowed to use this brought forward capital loss. But if this brought forward or carried forward capital loss was realized on sale of such asset which was acquired before joining the group, well, such losses are called pre-entry losses. And make sure, if there are any pre-entry losses in any company, pre-entry losses are those which were realized upon sale of assets which were sold before joining the group, and these losses could not be settled against gains in any group members through no gain, no loss transfer. Rather, these losses will be deducted in respect of gains arising upon disposal of those assets which were either acquired before joining the group or acquired after joining the group but from a third party. So that is all about capital gain group. Well, as far as overseas aspects of companies are concerned, I have written them in detail over here with all of its required constituents with examples.